Hello everyone. Lately, I have heard a lot of people debating and doubting the long term investment strategy in the Indian share market. They are trying to justify that India is a capital rotation market now and long term investing does not make much sense anymore. So, I thought of creating this video in which I am going to explain the long term investing in detail and will leave the decision of its significance and relevance in these modern times entirely up to you. So, let's explore it in detail. Before moving on, please read the entire disclaimer carefully. So, what is long term investing? Long term investing is an investment strategy where you buy and hold investments, primarily stocks or equity related instruments, for an extended period, typically several years, often even 5 years, 10 years, or sometimes even more. The core idea is to benefit from the fundamental growth of the underlying businesses and overall Indian economy rather than trying to profit from short term price fluctuations. Long term investors focus on a company's financial health, management quality, competitive advantage, growth prospects, and industry trends rather than daily news or price movements. Unlike short term trading, which focuses on quick gains over days or weeks, long term investing involves a commitment to holding assets for an extended duration. This allows your investment to ride out market volatility and benefit from the inherent growth trajectory of the well chosen companies. So, we are going to see six aspects of long term investing. First, we are going to see the various strategies in long term investing. Next, we are going to see the advantages and disadvantages of long term investing. Third, we are going to see the right approach towards the long term investing. Next, we'll see the myths and mistakes to avoid during the long term investing. Next, we'll see the risk involves and way to avoid those risks. And finally, we'll see the investment instruments available for long term investing in the Indian share market. So let's start with the first one, which is the strategies. Now, there are six most common and effective long term investment strategies. First is called buy and hold. Now, this is perhaps the most fundamental long term strategy. Investors purchase assets like stocks, mutual funds, or ETFs and hold on to them for many years, regardless of short term market ups and downs. The belief is that over the long term, markets tend to appreciate, and by staying invested, you capture that growth and benefit from compounding. Number two is the value investing. Now, this is pioneered by Benjamin Graham and popularized by Warren Buffett. Value investing involves identifying and buying stocks that are trading below their intrinsic value, that is, their true value. These are often companies that are temporarily out of favor or overlooked by the market but have strong fundamentals. Next strategy is the growth investing. Now, growth investing focuses on investing in companies that are expected to grow at a faster rate than the overall market. These are often innovative companies, those in emerging industries, or those with unique products or services. They often reinvest their profit back into the businesses to fuel further expansion. Moving on to the next one, which is the dividend investing. Now, dividend investing is also called as the income investing. This strategy focuses on investing in companies that regularly pay out a portion of their profits to shareholders in the form of dividends. The goal is to generate a consistent stream of passive income. Next is the index or ETFs investing. Now, instead of trying to pick individual winning stocks, this strategy involves investing in an entire market index like Nifty 50 or Sensex or Nifty small cap, Nifty mid cap, Nifty index 50, etc. through index funds or ETFs. The goal is to match the market's performance, not to beat it. And number six is the asset allocation and rebalancing. Now, this strategy involves determining the ideal mix of different asset classes. For example, 60% stocks and 40% bonds, etc., based on your financial goals, time horizon, and risk tolerance. Over time, as market values change, your allocation will drift from your target. Rebalancing means periodically adjusting your portfolio back to your original target allocation. Okay, now let's move on to the advantages and disadvantages. So, first advantage is the power of compounding. This is arguably the biggest benefit by allowing your investment returns to generate further returns. Your wealth can grow exponentially over time. This snowball effects makes even modest regular investment grow substantially over decades. Next advantage is the reduced impact of market volatility. Now, short-term market fluctuations, often driven by news or sentiments, tend to average out over a longer period. Historically, equity markets have shown an upward trend over many years, allowing investors to ride out downturns and benefit from eventual recoveries. Next is the lower transaction cost and taxes. Since long term investing involves fewer buying and selling activities and holding on to the equities for a longer term, you incur lower brokerage fees, STT, that is the securities transaction tax, and other charges. Also, LTCG, that is the long term capital gains tax on equity, are taxed at a lower rate, around 12.5 at the moment, on gains above 1.25 lakhs in a financial year, for the equities that are held for over 12 months compared to STCG, that is the short term capital gain. Next is the emotional discipline and peace of mind. Now, a long term outlook reduces the temptation to make impulsive decisions based on daily market noise or panic. This helps investors stay disciplined, stick to their strategy, and avoid costly mistakes driven by fear or greed. It often leads to less stress and more peace of mind. This also involves lesser investment of time in the market. So, in long term investing, once you are done with your investment, you do not have to invest a substantial amount of time in the market anymore, which is unlike the case in swing trading or short term or intraday trade, etc. Next is the alignment with financial goals. Now, long term investing is ideal for achieving significant life goals like retirement planning, funding child's education, buying a house, planning for or funding for children's marriage, etc. As these goals typically have a long time horizon. Next is the benefiting from economic growth. Now, in economies, especially like India, which are on a long term growth trajectory, investing in fundamentally strong companies allow you to participate in long and benefit from the country's overall economic expansion and corporate earnings growth. And seventh and final advantage is time for recovery. Even if your investments face a significant downturn, a long investment horizon provides ample time for the market and your portfolio to recover and eventually grow. Now, let us look at some of the disadvantages of long term investing. First is liquidity constraints. Now, while stocks and mutual funds generally offer liquidity, that is, you can sell them anytime you want, the very nature of long term investing means your capital is tied up for a extended period. If you need the money for an unforeseen emergency in the short to medium term, liquidating long term investment might incur losses if the market is down, or you might have to pay higher taxes if the holding period is less than the long term definition. Next disadvantage is the opportunity cost. By holding investments for the long term, you might miss out on potential short term trading opportunities that could offer quick gains. However, consistently capturing such opportunities is extremely difficult. Next disadvantage is the require it requires significant patience and discipline. Now, the buy and hold strategy sounds simple, but it requires immense patience and discipline, especially during prolonged bear markets or periods of underperformance. Watching your portfolio value drop without reacting on it can be significantly challenging, especially psychologically. Okay. Next is the risk of permanent capital loss. Now, while stock market risk or the market risk is mitigated over the long term for diversified portfolios, if you invest heavily in a single company that goes bankrupt or performs exceptionally poorly over decades, there is a risk of permanent capital loss. This highlights the importance of thorough fundamental analysis and diversification even in long term investing. Next is the need for periodic review. Although it is a buy and hold and it is not buy and forget. This is a very crucial point. It is buy and hold, not buy and forget. You still need to periodically review your portfolio to ensure the underlying companies remain fundamentally strong and that your investment thesis is still valid. Economic or industry shifts can impact even blue chip companies over very long periods. Okay, and the final disadvantage is the inflation risk. Now, this is specifically applicable for a very low return long term investments. Generally, equities typically beat inflation over the long run. Certain safe long term investments like fixed deposits might see their real returns eroded by inflation over very long periods if the interest rate doesn't keep pace. So, although chances of inflation risk are very less in long term investing, especially if you have done the proper fundamental analysis and chosen the right companies, but still it is one of the risks which needs to be mentioned. Okay, now let's move on to the approaches. So the right approach for the long term investing is, first of all, define financial goals. You should be very clear why you are doing a long term investing. You must set the goals. Are you doing for retirement, for your child's education, for a new house, for your child's marriage, or whatever it may be? The goals should be very clear, and and your portfolio should be aligned to your goals. Next is assess risk tolerance. Now, this is very important. This is the risk that you can take in which you are comfortable. Now, consider it. This is the amount of money which, if you lose, it is not going to derail your life. So, this is what risk tolerance means. This is that much amount of money which would not derail your entire life if you lose that in due to any kind of risk that we have seen in the previous slide. Okay, very important. Next is diversification. So again, do not put all your money in a single company, in a single sector, in say in small cap or one asset class. Diversify your portfolio. Invest in multiple sectors across multiple market caps, across multiple asset classes. So that doing that reduces your risk significantly. So it is a good approach for long term investing. Next is quality companies. Now focus on fundamentally strong businesses with good management, consistent earnings, and competitive advantages. Never ever check the last 1 year, 2 year, 3 year returns of any company. I'm not saying that it cannot, a company having a higher last 1 to 3 year returns cannot be good. It can be good, but that should not be your only criteria before choosing a company. Okay. Next one is the regular investing SIP. Now, this is again something which is in news a lot lately, in which people are coming out and saying that SIP is not worth doing or continuing anymore. That is not the case. Now, systematic investment plans for consistency is very important. Again, you have to apply your mind. You cannot be dumb and just keep on doing SIP without thinking. Apply your mind. If for example, just an example, if you clearly see that um, the market is going to, or for example, today is your day for investment and the market, you know that tomorrow is market is going to crash because of a tariff announcement or something. It does not make sense to continue or release your SIP today. Wait for a day or two and then do so. But SIP is irreplaceable. You got to do SIP for a long term investing. Next is patience and discipline. This is the hardest but most crucial part of long term investing. You got to be disciplined. You got to have some patience. Do not worry if your portfolio is not giving the returns that you want them. Give it some time. And if you have chosen proper companies, right companies, good companies, it will eventually give you the desired returns. And finally, review and balance. Periodically check if your portfolio still aligns with your goals and risks. So although you do not have to sit in front of your mobile or computer all day and keep on looking at the trade the entire hours, but still once a week, once in 15 days, you got to check your portfolio. Okay, let's move on to the myths and mistakes. Now, first myth or the mistake is trying to time the market. This is a futile attempt to accurately predict market highs and lows to buy and sell at optimal times, a strategy that rarely succeeds for most investors. So do not try to do that. Yes, do not be a dumb investor, but do not try to time the market perfectly. A trend is okay, but timing pinpointly is not possible. Next is over or under diversification. Now, this refers to either spreading investments too thin across too many assets, making management difficult and diluting returns, or concentrating them in too few, thereby significantly increasing the risk. So, there should be a good balance between over and under diversification. Next is the panic selling during corrections, as we have seen in last few months in the Indian share market. Now, this occurs when investors, driven by fear, sell off their holdings during market downturns, often locking in losses instead of weathering the storm. So, especially in long term investing, you got to have patience and you should not do panic selling. Yes, if the fundamentals of a companies have changed, then it's okay to uh, sell out or to rebalance. But panic selling is not a solution. Moving on, next is falling for get rich quick schemes. Now, the only thing that you get quickly in the share market is to lose money. You can lose money quickly, there is no doubt about it. But for you to get rich, you got to give share market some time. You got to do your homework and pick up good companies, good fundamentally strong companies, and give it some time. And the last one is not doing your own research and relying on tips from social media or news or whatever. This is a mistake of making investment decisions based on unverified information or others' advice rather than conducting thorough due diligence yourself. Very important. Now let's move on to the risks. Now, first risk is the market risk. This is the risk of overall stock market declining due to economic downturns, global events, or shifts in investor sentiments, similar to what we are observing for last few months now. You can mitigate this by diversifying your investments across various asset classes and sectors and by maintaining a long investment horizon as markets historically recover and grow over time. Next is the inflation risk. This risk refers to inflation eroding the purchasing power of your investment returns. While your money might grow numerically, its real value could decrease. Historically, equities have a strong track record of beating inflation over the long run, making them a good hedge against it. Next is the company specific risk. Now, this risk is tied to poor performance, bankruptcy, or negative events affecting a single company you have invested in. You can mitigate this by diversifying your portfolio across multiple companies and sectors and by conducting thorough fundamental analysis to invest in financially sound companies. Next is the liquidity risk. Now, this is the risk of not being able to sell your investment quickly enough or without significant loss when you need cash. This is generally less of an issue with actively traded large cap stocks and well managed mutual funds as they have high trading volume, ensuring buyers are always available. And fifth is the political or regulatory risk. Now, this involves the potential negative impact of changes in government policies, regulations, tax laws, or geopolitical events on your investments. Now, you can mitigate this through constant monitoring of the economic and political landscape and by diversifying your investment geographically if you invest internationally. Now, this is one risk which you have limited control of, but diversification and long horizon could actually help you in this situation. Now let's move on to the investment instruments available for long term investing. First is the direct equity or the individual stocks. Now, this involves directly buying shares of individual companies on the stock market. It offers the potential for high returns if you pick the right companies, but it also carries the highest risk and requires significant research and active monitoring. So, it involves investment of time as well. So, it's up to you how much time do you think that you can take away from your daily life. Next is the equity mutual funds. Now, these funds pool money from multiple investors and invest predominantly in a diversified portfolio of stocks managed by professional fund managers. They come in various types like diversified, large cap, mid cap, small cap, and flexi funds, offering professional management and diversification. Next is index funds and ETFs. This is also called as passive investing. These instruments aim to mirror the performance of a specific market index like Nifty 50, Sensex, Nifty Index 50, etc., rather than trying to beat it. They offer low cost and broad diversification, providing market average returns. Okay. Next is the ELSS, equity linked savings schemes. These are a type of equity mutual funds that provide tax benefits under Section 80C of the Income Tax Act with a mandatory 3-year lock in period. They offer the dual advantage of tax saving and potentially equity market returns for a long term horizon. And fifth is the retirement funds. Now, these are investment vehicles specifically designed to build a corpus for retirement, such as NPS or dedicated retirement mutual fund schemes. They typically involve long investment horizons and often come with tax benefits. So we have seen everything. Now let's conclude it. So to conclude, the significance and relevance of a long-term investment depends on your individual financial goals, risk tolerance, time horizon, and personal circumstances. It also includes how much time you can actually invest along your money. How much time can you invest in your daily life in the share market? My opinion, if you are investing in the share market for increasing the returns on your savings and have a full time job elsewhere, then there is absolutely no issue in long term investing, provided you have done your homework and have chosen the fundamentally good companies. But if you are a full time trader, then you have several other additional avenues available with higher risk and reward ratio in the Indian share market. So the Indian share market has plenty of opportunities to make money for all style of investment. It is you who have to decide which style suits you the best. Thanks for watching this video. Please like, share, comment and subscribe to the channel. And I'll be back soon with another video. Goodbye for now.